Welcome to NASDAQ Trade Talks. I'm Jill Malentrino, Global Markets Reporter at NASDAQ. Joining us remotely, we have Tony Zhang. He's Chief Strategist over at Options Play. We're going to take a look at how to position during extreme market volatility and uncertainty. Tony, it's great to have you with us. Thanks so much for making the time. And certainly these are unprecedented times as human beings, especially with the markets. Just give us a quick update. What are you looking at here?
Yeah, first, thank you so much for having me back on. I just want to start off by saying I hope everyone is staying safe and staying at home. And I think we just need to all do our part, as tough as this is, to help stop the spread of this virus. And as you said, markets are extremely volatile. So what we really want to look at is a little bit of the data to help us guide us in terms of what we want to take a look at to understand what it might be the larger economic impact of this virus, to help us give us, first of all, our directional view on the markets, and then second of all, how we can utilize perhaps options to best position ourselves in these types of volatile times. So those are some of the things I want to take a look at here today.
All right, Tony, thanks so much for saying that. And we'll get right into it with our first slide. And you've broken it down into 3 different points to help you come up with these strategies.
Right, exactly. So first and foremost, we want to take a look at the macro viewpoint, because at this point, some of the technical levels that we take a look at might be useful to give us some timing, but it really isn't helpful at this point for directional view. So we really have to take a step back, look at things like economic trends from high frequency data that we do have access to, looking at some countries that are a little bit ahead of us, like China and Italy, to give us a sense for both magnitude and length of this type of economic impact. Then what I want to take a look at are correlations and liquidity, because I think that's really important for us to understand what should we trade, not just what directional view should we have on the markets. And lastly, I want to talk a little bit about what option strategies are suitable for this type of extreme volatility, which is actually quite difficult to trade.
All right, moving along to our next slide here, and this is a great place to start, hedging best practices, because if you didn't have a hedge on prior to going into this market volatility, I'm sure you're certainly willing to learn more about that now.
Yeah, so we have covered this topic heavily even before the sell-off. So I do hope that some users were able to capture some of that information prior to the sell-off. But if you did not attend some of these events that we've been doing, first and foremost, when we're talking about hedging your portfolio, it's important to understand there is what we call a perfect hedge, which is moving your assets to cash if possible and reinvest after the correction is complete. This is the best hedge that you can possibly put on your portfolio, but not every asset do you necessarily have the ability to move to cash. So for the assets that you want to remain in the markets or remain invested in the markets, what you want to do is, first off, you want to start off by buying a put option on a broad-based index that's correlated to your portfolio. We're going to give you some examples of this today. Now, the thing to remember is that during these extremely volatile times, buying puts are really expensive. So the best way to offset the cost of that extremely expensive put option is to sell some short-dated options and generate some income to offset the cost of that really expensive put option at this point. And then the third point, a lot of questions that we get asked are, when do you actually exit a hedge? So, in these types of times, it's important that we actually continuously roll our puts as they become profitable and provide protection on our portfolio. But also, one of the metrics that we look at is volatility. When volatility peaks, that gives us an indication of when it might be time to take off a hedge.
All right, and moving along to our third slide here, and I think this is really where investors, markets are struggling. How do we actually model out the longer term impact of the coronavirus? And it looks as if you are looking at 4 different areas that's really going to help us model that going forward.
Yeah, exactly. So the screen is split into 2. On the left side, I kind of have what we would consider the downside, if you will. So predominantly what we're looking at is COVID-19 trends. Specifically, we have daily data in terms of number of new cases, deaths, unfortunately, and recoveries. And we take a look at China as a template and see how Italy, US, and Spain, which are the 3 largest countries at the moment, are trending with China. Currently, unfortunately, Italy being ahead of US and Spain, the numbers currently are still getting worse. Sunday, yesterday was the first day where things started to look better, but one day does not make a trend, unfortunately. And we have seen these daily improvements, but then they just get worse. So at the moment, things are still looking like they are going to get worse. And part of it is because these countries have not been able to institute the same type of draconian measures that China has. So that is how we model the length that we expect these impacts to have. Then what we look at is the economic impact, the magnitude. And this is where we also have to, at this point, look at Chinese numbers to provide some guidance. At the moment, we're looking at February about a 30 to 40% decline in economic activity in China. And the question is whether or not we're going to see the same types of declines here in Italy and US multiplied by that length. And that gives us some idea as far as the downside. And then when we look on the upside, monetary and fiscal policy are really what governments can do to try to help offset some of these downsides, if you will. We've seen fairly swift monetary action across central banks right now, either through QE or through rate cuts. Sweden and Norway both have announced either rate cuts or QE. Sweden, unfortunately, at zero, cannot really move much lower. I actually think the bigger response from governments is really on the fiscal side. Both US and Europe currently have major policies that are on the table to be voted this particular week. These may provide some stability in the markets, and I think that is part of some of the quote unquote calm we started to see at the end of last week. And even this week, we certainly have less of that panic feel in the markets. So if governments can come together from the fiscal side, that's really where I can see some stability coming into the markets. But that also is our biggest risk of further downside if there are any stumbles on fiscal policy.
Okay, Tony, let's move along to our next slide here and take a look at some levels that you're watching in the OMX S30 index, and you're back near 2014 and 2016 lows.
Yeah, exactly. So unfortunately, we've had this huge move to the downside. We've never seen moves this fast before in any market, down from that 1900 level all the way down to 1300, near the 1250 support, which was the lows from 2014 and 2016. That's the major support level that we have here on the table. Now, like I said, technicals kind of go out the window right now. Fundamentals is really what's driving this. So if we do see that break below 1250 as things can potentially get worse, we are targeting 1175 to the downside is our first target, but even further down about 850, which puts us more than 50% from the peak. So those are some of the downside targets that we're looking at. To the upside, 1450 is a major resistance level on this particular index. I think if we do get back to those levels, that might be a time to consider getting short again in this particular index.
Is this index trading better, worse, the same than the US indexes?
It is certainly further down than the US indices at the moment. And, we are targeting potentially further downside, again, more than 50% of the downside. This is revisiting 2014, 2016 lows. We haven't quite gotten there on the US indices yet.
All right, let's move along to our next slide here and talk about correlations and liquidity. And also explain to us, why do you look at correlations? Liquidity is understandable. We want to make sure we can get in and out of our trades, but why are correlations such an important indicator?
So correlations are so important from the perspective of understanding what should we trade, right? So even though we believe that the markets may continue to move lower, correlations give us an understanding as to whether we should trade the broader market, such as an index or ETF, or if we should pick single stocks. And based on the correlations, as you can see, and I have the correlations here of the US markets, but the Nordic markets are very, very similar. They usually range in the 30-40% range, which means stocks, you have a nice mixture of stocks moving higher and stocks moving lower. And as you can see over the last month, this has exploded into that 80 level. It has pulled back a little bit back to the 60 level, but we're still talking about a high amount of correlation, meaning stocks are moving lockstep with each other. When the markets sell off, all stocks sell off. When the markets rally, all stocks rally, which makes it less suitable for picking individual stocks. So when you marry the correlation, the high correlation, and the lack of liquidity in single stocks, this means that it's better in this type of market environment to trade indices such as the OMX S30 index rather than picking single stock names in this particular type of environment.
All right, let's move along to our next slide here and look at some strategies. I mean, what do you trade in a market that's as volatile and short-sighted as this one?
And that's exactly the biggest challenge here is no matter what option you take a look at, it is extremely expensive, regardless of whether you think that markets are going to bounce higher or you think they're going to continue moving lower. Buying a call or a put is extremely expensive. However, due to the extreme volatility, you can also use that to your advantage using a calendar or diagonal spread. And these are spreads where we're buying a long dated option. In this particular case, on the example here, I'm looking going out to June, which is roughly 3 months away. And I'm buying a 1270 put on the OMX S30 index, a near the money put. As you can see, that's costing me 116 crowns, which is almost 10% of the index value. That is almost unheard of in these types of market environments, to pay 10% of the index value to buy a 3-month put option. But what I can do is that I can sell a very short dated option against it. In this particular case, I'm going out to March 27th, which expires this Friday. In just 4 days, I'm going to collect roughly 31 crowns. So I'm going to collect almost a third of the cost of buying that June put by selling a 1 week put against it. So the 1 week volatilities are even higher than the June volatilities. So what I'm really doing is I'm taking advantage of the fact that long dated options have slightly reduced implied volatility and short dated options have very high volatility. So I'm going to buy that long dated option that gives me the downside exposure that I want, so to protect my portfolio and if the markets continue moving lower. And I'm going to sell very short dated options against it to offset the cost of buying that long put. And hopefully by this Friday, those puts will expire worthless, or I have to buy them back. And then what I want to do is I want to keep selling short dated options against the long put to reduce the cost of buying that long dated put. That's really the strategy to trade in this type of very, very volatile market environment.
All right, Tony, always well said, always a voice of reason. Let's wrap up with our last slide here and how people can get in touch with you and Options Play.
Yeah, so again, this is a new partnership that NASDAQ and Options Play have launched back in 2019. And learning how to trade options, it's something that takes time for everyone. So if you're new to options trading, you can sign up for both the tools, the education, and the resources that we all provide to Nordic customers completely free of charge as optionsplay.se. We're actually going to be doing an in-depth market overview session in conjunction with this Trade Talks to give Nordic investors more information about what's currently going on in the market and keeping them up to date. So you can sign up at optionsplay.se.
All right, Tony, great to have you with us as always. Thanks so much for making the time.
Thank you so much for having me.
All right, and thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.